Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to asset mix and financing mix. Our focus this time being on breaking out the assets into what we'll call temporary current assets, permanent current assets, and fixed assets to help us think about what kind of financing needs we might want in order to apply them to our asset mix. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 622 Asset Mix and Financing Mix tab in the Practice Problems section. Closing this back out, we're going to go over the information up top, then we'll have a smaller component of that information that we can use to go through the practice problem. So we've got our assets up top. This is going to be the kind of the new thing here is we're going to be breaking out our assets into what we'll call temporary current assets, permanent current assets, and fixed assets. Now these first two are going to be the new terms here. The fixed assets could be property, plant, and equipment, the depreciable type of assets here. But the temporary current assets and the permanent current assets seem a little bit strange. Temporary current assets seems kind of redundant because it's already a current assets. Permanent current assets seems like a contradiction of terms. So how can something be a permanent current asset? A current asset is something that is going to be current. It's something similar to cash, things like accounts receivable and inventory. Now note that we can, although they are current and they will be turning over, the accounts receivable turning over all the time, we can assume then that there's going to be some minimum level in accounts such as accounts receivable, such as the inventory, because although they turn over, they're going to be replaced all the time with new sales. Every time we make a new sale, it's going to be replacing the amount that's in the current accounts receivable. So it's churning, but it's always at some kind of set amount that will be, in alignment, you would think, to the sales volume and our collection capabilities. Same with the inventory. It's going to be churning all the time, but you would think we would be trying to maintain some standard level of inventory given a certain sales level. And then the temporary current assets, what then would constitute temporary current assets? Those would be the ones that are actually temporary. For whatever reason, we don't think they're going to be turning over all the time, and therefore they might go down at some future point in time. And that might be a result, for example, of something like a spike in sales would result in a spike in the accounts receivable for some time period until the sales basically go back down to a normal point. So we would expect the receivable to go down. Same with the inventory. A spike in sales might result in a spike in inventory as we do our best to compensate for the increase in the sales until the sales basically go back down. So if we can then fix these terms, and then we think about basically our accounting equation as assets equal liabilities plus equity, then we can think about how we're going to finance the assets either with liabilities or equity. We're focusing here on financing with the liabilities. As we think about these loans, we can break out our financing needs then to more aggressive short-term financing, less aggressive long-term financing based on possibly our assets here, whether they be temporary or permanent in nature. So if we scroll down, then we're going to say the short-term loan rate is going to be 10%. The long-term rate is going to be the 15%. Remember that the 10% is typically going to be more aggressive because it could change maybe in the future. It might be more of a flexible rate or something like that. The long-term rate is going to be higher oftentimes because you have more surety with it and a longer loan and possibly a locked down rate for it. So you're trading off the risk and reward possible benefit with those plans with those two rates. Earnings before interest and taxes, 1,050. Tax rate's going to be the 35%. If both long-term financing and short-term financing are perfectly matched with long and short-term asset needs, what is earnings after taxes? So we're going to be matching up then our financing needs, short-term and long-term, to basically the short-term, which we're going to say is the temporary current assets, and then the long term, which we're going to say are both permanent and the fixed assets, and then match up our financing needs with that. Now to consider this, let's go down here. We're going to think about our accounting equation. Here's a smaller kind of recap of our numbers. Now remember the accounting equation, assets equal liabilities plus equity. Whatever assets that we have, we need to be financing either with liabilities or equity. We're focusing here on financing the assets that we're going to use in order to generate revenue with liabilities. So if we're financing them with the liabilities, then we got to consider what type of loan are we taking, more aggressive or less aggressive loan. We can attempt to match out a more or aggressive, less aggressive loan with the type of asset mix that we have. So if we went into the balance sheet, we would have to then break out in the balance sheet, because it's only going to have current assets and property, plant, and equipment. It's not going to be breaking out our balance sheet to temporary and permanent current assets. But we can then go through there and try to break them out, and that could be useful for this type of analysis. And then if we match this out, one way we might match this out is then to say, okay, let's use permanent financing for the permanent current assets and the fixed assets, which might be more long-term type of things. And then we can use the temporary financing for the temporary current assets, which may then go down because we think they're temporary, which means we don't need the financing for them once they go down on it, right? If we get paid on, like, say, the receivables or something like that, we will have the cash flow at that point in time. So that's one method we can use, or we can use this kind of breakout to then think about what our optimal or how aggressive we want to be in our financing mix in a more practical type of way that gives us more information. So let's take a look at the long-term financing needs then. The permanent current assets, we're going to say, are going to be that 1,500. So these are the permanent current assets, the 1,500. And we're going to say that the fixed assets are going to be that 1,600. That's going to give us a total of the 3,100. And this is going to be for our long-term financing needs. We're going to add those together. Then we have the short-term financing needs, which we're going to say are just going to be that 2,000. So we're just breaking out the 2,000, which are the temporary current assets, short-term financing, these two, adding them together for the long-term financing. Then we can think about our interest expense. The long-term interest expense is going to be the 465, that calculated as, let's pull out the trusty giant calculator here, giant trusty calculator. We have the long-term financing at the 0.15 times 15% times the amount that we're going to be financing long-term, which we said was that 3,100. So times the 3,100. That's going to give us our 465. Short-term financing then, we're going to be taking that 2,000 there, the 2,000 times, and then we'll pick up the rate up top, short-term 10% times the 10%, 0.1. That's going to be our 200. Adding those together, we would then have the total financing, or the total interest, would be the 665, given those rates on the financing. If we then put together the income statement, then the earnings before interest and taxes were given to us at the earnings before at the 1,050. So this is basically the bottom line of the income statement, net income before we consider the interest expense, which we just calculated, and the taxes. So then if we take that amount, we then consider the interest expense of the 665, subtracting those out, that gives us the earning before taxes of the 385. Then we're going to be picking up the taxes at the 135, the taxes being calculated as the 385 times the tax rate, which was 35%, 0.35. That's going to give us the 135, about the 135. And then if we subtract the 385 minus the 135, we're going to get the 250, the 250. So again, the new kind of concept we're considering here for the most part is going to be breaking out the temporary current assets and the permanent current assets, and using those to be considering what we're going to do for the short-term and long-term financing mix.